Hi guys, my name is Yanni, that's David, this is James, and this is our MarketView presentation. And today we're going to be comparing two currency pairs. Our first currency pair that we're looking at today is AUD/USD, which is currently trading at where one Australian dollar fetches 0.79 USD. Our second currency pair is AUD Great British Pound, where one AUD trades at 0.58 British Pounds. Our objective today is to determine whether or not the AUD will appreciate against the USD and or the Great British Pound. To do so, we must consider the following economic indicators: relative interest rates, relative inflation rates, and relative growth rates. According to the RBA, Australia's current cash rate is at an all-time low of 1.5%, which has remained unchanged since August of 2016. Sourced from globalrates.com, as of June this year, America's cash rate is 1.25% and has been on a steady increase since the global financial crisis years ago. Fundamentally, interest rates are used to counteract the effects of inflation rates. The goal of Australia is to have an inflation rate between 2 to 3%. When inflation is low, in theory, interest rates will be cut to stimulate spending as it becomes less attractive to save as return rates are diminished. Conversely, when inflation rates are higher than what is considered sustainable, interest rates are raised in order to decrease consumer spending, making saving money more attractive, therefore decreasing inflation. If interest rates in Australia were to rise and become greater compared to other countries, foreign investors will seek to purchase AUD as they will get a greater return in comparison to investing in other countries. Therefore, the AUD will improve against other currencies. In conclusion, a range of experts used by finder.com.au believe the current cash rate of Australia in the coming months is expected to remain unchanged. Furthermore, the US cash rate is forecast to increase by 2018.
Australia's goal in terms of inflation rates is a sustainable rate of 2 to 3%. The current CPI of Australia is 1.9%, which has been an improvement with a decrease more recently from June of 2016, which was at 1%. The future economic outlook with the current monetary policies in place expected the Australian inflation rate to increase slightly to 2.1% in the next year, as there is expected to be tightening in labour and product markets. Similarly, according to globalrates.com.au, America's most recent CPI figure is 1.9%, which is also increased from August 2016 of 1%. However, it has been fluctuating over periods from then to now. America's inflation rate target is 2%, although their project inflation rate is expected to be 2.2% in 12 months, according to normal.com. Throughout this similar CPI, it becomes apparent that the difference of values of each currency is due to other factors. However, following traditional economic conventions, it has been seen that said countries that experience high inflation rates, that is, trading partner, the demand for exports will be lower, leading to less of demand from the national currency, coinciding with the fact that there will be more demand for imports, meaning supply of the currency will be greater than the demand, leading to a slight depreciation of the current value in regards to the future inflation level of Australia. According to RBA, Australia's ideal growth rate is between 3 to 4%. Currently, it is 1.8 as of June 2017. Despite not being in close proximity of the ideal growth, the Organisation of Economic Cooperation and Development has given Australia a positive appraisal as it expects the economy to grow towards 3% by the end of 2018. As a result of low interest rates being maintained at 1.5%, the majority of the current growth is made from strong domestic demand and net exports. Furthermore, OECD.com believes we should see a gradual increase in growth rates of Australia and almost reach 3% by 2018, as the drag on growth from declining resource sector investment will fade and gather momentum outside the resource sector, will support wage and employment growth, thus boosting consumer spending. America's growth rate as of June this year is 3%, which has increased from the first quarter of 2017 growth rate of 1.4%, and being the strongest growth rate since 2015. The main contributor to the current growth rate is the improvement in domestic consumption. This increase in domestic consumption has aided by the continuous steady improvement of the unemployment rate, although has retained steady over the more recent couple of months at 4.3% approx. Despite this more recent lack of continual improvement, America's unemployment target is below 5%. Despite this improvements, the US growth rate has forecasted to decrease to 2.2% by 2018. With Australia's cash rate to remain unchanged, whilst America's to increase slightly by 1.5%, the inflation rate of both countries to increase similarly, but Australia's growth rate to increase and America is expected to decrease. We believe that the Australian dollar will appreciate against the US dollar and go into the region of $1 Australian dollar, fetching 0.83 US dollars by 2018.
Now we will begin to compare the economic indicators between the Australian dollar and the British pound. As previously stated, Australia's interest rate has remained at 1.5% for the past year, as well as the UK's cash rate, which has also remained consistent for the past 6 years until 2016, and now dropping to 0.25% for the past year. In 2016, the UK interest rate had dropped from 0.5% to 0.25% last year when UK had a referendum and decided to leave the European Union. This is also known as Brexit. The decision to leave the EU resulted in the value of the British pound to drop, and in return they attempted to drop the interest rate to counteract the value drop, and has remained at 0.25% ever since. Since the decrease to more recent times, the website thisismoney.com believes whilst they have lowered interest rates to accommodate the falling pound, they have spent $60 billion on qualitative easing. They've spent $10 billion on corporate bond buying and $100 billion for funding the lending home scheme. Whilst all the interest rate cut and the influx of money, it shows the pound had been affected significantly from Brexit. Proceeding on, with the recovery of Brexit still occurring in 2017, the UK interest rates are expected to increase back to 0.5% by 2018, as there has been low wage growth and higher inflation eats into spending power, so increasing interest rates will mean people will find saving slightly more attractive than previous compared to spending. As mentioned previously, the current inflation rate as of June 2017 in Australia is 1.9%. The British inflation rate is currently sitting at 2.8% as of August 2017. The British inflation rate has been on a steady increase, becoming more significant marginally to previous periods since the referendum period last year, where it had risen from 1% approximately to 2.8% in August of 2017. This can be explained from the continual increase of domestic spending on goods as interest rates were cut. Consumers found saving less attractive and decided to borrow as it was more feasible than previous periods in order to spend and consume goods. The government cut interest rates in an attempt to increase spending so that the value decrease in the pound from Brexit can be counteracted. Looking forward, it is expected that the inflation rate of Britain in the coming months will remain the same. Proceeding forward, the GDP rate in Australia is currently 1.8%, with an expected rise to 3% by 2018. The United Kingdom's growth rate is 0.3% as of August 2017. It has remained quite steady over a long period of time, with improving and decreasing fluctuations. Looking more recently, it has declined since the turn into 2017 of 0.7% to a low of 0.2% and has since recovered minimally to 0.3% more recently. Coming into 2017, there was a strong growth in government spending and investment, which was a result from the referendum in 2016, whilst household consumption rose at a slower rate and business investment stalled. The most recent recorded unemployment rate in Britain is 4.3%, according to ons.gov.uk. Whilst this is below the healthy range of 5%, without the ability to increase the country's production, the possibility frontier of the UK will find it hard to increase economic growth despite the low interest rates. It is expected in the coming months that the growth rate in the United Kingdom will remain steady at 0.3% going into 2018. As stated, with only Britain's interest rates to rise, whilst inflation and growth rates to remain the same, we anticipate with the expected changes to happen with Australia in terms of the economic indicators. We expect that the AUD will appreciate against the British pound, where £1 fetches 1.69 AUD as at of the 19th of September 2017. In the coming months, closing in on 2018, we anticipate that £1 will fetch 1.75 AUD dollars. Thanks for watching our MarketView presentation.